has a factory in North Carolina, for example. Well, they actually do. A huge factory. So is this asset, the factory building, measured in euros or US dollars? What would you say?
Will be Euro because it's a German company.
Yes, we have to assume for any company one functional currency. That is called functional currency. That is the currency the company mainly operates in. And as it's a German company, we typically use the currency of the land of the country where the company is based. So in this case, Germany, which would then be the euro. There are a few exceptions to that rule. Most notably, oil companies from the Middle East mostly use the US dollar as their functional currency in the company, because the world market for crude oil and oil is typically nominated in US dollar. So they do most of their business in US dollar. And so there might be a distinction where they use the functional currency as the dollar. But we have a German company, so our functional currency is the euro. So what would you say, was the asset originally purchased in euro or US dollar? And does that really matter?
Yeah, it does matter because the exchange rate is not mostly stable between euro and the USD. But it changes time to time.
Mm-hmm. It changes, yeah.
And it was originally purchased in USD because the asset is located in USA.
Yes. There's a little in reality, you would there is this question: was it purchased in euro or US dollar? Because it's kind of question of the choice of payment provider. Do you switch your euros into US dollars first and then pay in US dollars, or do you pay the seller in the in the USA in euros, and then he or she switches that or exchanges that to US dollars? So there might be a distinction here if you pay in euro or US dollar, but the central question here is, does it matter? From a accounting point of view, it doesn't. It does not matter whether the asset was originally purchased in euro or US dollars. We assume now that we paid in US dollars. So at which point in time do you calculate the conversion? So we have the initial cost on December 31st, 2017 of 10 million US dollars and a useful life of 50 years on the factory. Sorry.
You calculate at the end of the year?
Yeah, we have that at the end of the year. So let's say, what would be the book value for the German company from the perspective of the German company on December 1st, 2022?
Well, it would be the price of the US dollar compared to the euro, or at least currently.
Okay, so you would assume we calculate that at the end of 2022?
Yes.
Okay. Are there any other opinions or any other way we could do that?
We could potentially calculate it every time the value switches, but it could switch every day, so it would be highly inefficient and unlikely to do so.
Yes. There is a very clear way how we do deal with that from an accounting point of view. So we typically, I have that example here. We have the factory in the USA. So we have a German company. Therefore, all reporting is done in euro. That is very important. We cannot mix currencies on the balance sheet or income statement or in the annual financial report. We cannot do that. All our reporting is done in euros. That is very important. And also for this kind of asset, we do a currency conversion at the point in time of initial recognition. We do that once, but at the point in time of the initial recognition. And in the following years, we handle that asset the same as any German asset would be handled. So the initial value in 2017 is 10 million US dollars. We pay 10 million US dollars, which is, according to the conversion rate, 9.23 million euros.
Yes, correct.
Yeah. That is the value that we have in our company in euros calculated at the point of purchase. Then we have, through that, a yearly depreciation rate of 184,600 euros. Because we divide that euro value by 50 years. We have a useful life of 50 years. And now we handle that the same as any German asset would be handled. We have the initial value of 9.23 million euros and a yearly depreciation rate of over 180,000 euros. So because of that, we have a book value in 2022 of 9.23 million euros. That is our initial value, minus 5 times, because 5 years have passed since the end of 2017. Yearly depreciation rate, 184,600 euros, which leads us to a book value in 2022 of 8.307 million. So the only thing we have new here compared to any other asset, any other PPE asset that we handled in this course so far, is that at the very first point in time where we purchased that the asset in another currency, we do a currency conversion to our functional currency, which is in this case the euro. Okay. Any questions to that?
I have a question.
Yes.
So that does mean we also doesn't recognize the inflation and deflation in the economy. So if there is some countries have high inflation rate, 50-60%. So do these companies recognize it?
Typically, it would work just the same way, and we would ignore the inflation in the country where we have that asset. There are exceptions, however. like you said, there are countries with inflation rates over 50-60% on their currency, and that is a whole different story. And there's actually a separate IAS standard dealing with inflation for assets and all other aspects and transactions. So there's a specific standard for that, how to deal with high inflation countries. But typically, you would assume that the value that you have as inflation typically means a loss in value compared to other currencies of another currency. So the exchange rate would drastically change, for example, from US dollar to euro. But from your perspective as a German company, when you valued that at euro rate as euro, that doesn't affect your asset. In reality, it kind of does, because the resale value is affected, and that is the only thing we might have then in form of an impairment test, that the resale value calculated in euro changes for your asset. But in this context, we don't account for the inflation, except for specific cases when we have, like, as you mentioned, abnormally high inflation rates of, let's say, over 50%. But that is a whole different standard that we don't take a look at.
Thank you.
Welcome. Okay, so now we have, but this case here is for kind of a factory, property, plant, and equipment asset classic, as a classical case. But there is another case here, and that deals with foreign currency assets, or foreign currency assets, but foreign currency cash and cash equivalents. And for that, there's a specific paragraph in the standard that says at the end of each reporting period, at the end of the year for us, a foreign currency monetary item shall be translated using the closing rate. Because when you have, as an example, we have a German company now, the same German company, that has a bank account at the Bank of America in New York City with a balance of 10 million US dollars. And that is just liquid US dollars that you have in your bank account over there that you can use. You bought that at one point in time. Yes. For example, at the end of 2017, just like in this example here. So we have the initial value at the end of 2017 at 9.23 million euros. But would it now be practical to keep it on balance at 9.23 million euros? No, it wouldn't, because we have functional liquid money of that currency. So when we report at the end of the year, we have to translate that into euros, because we can't show on our balance sheet 10 million US dollars. That is not possible. Our balance sheet has to be in euros. But that value changes, as your colleague said correctly. The value changes over time. So I want you to do this next exercise that says, what is the book value of this foreign currency account at each reporting date? And what are the implications on the balance sheet and income statement? And also construct the accounting entries for each year. In the end, the end result should look something like that. So this is the exchange rate. Just a second, I can there we go. So you have the exchange rates here. You have the exchange rates here. We have 10 million euros in our bank account. What is the book value in euros at each reporting date? What is the valuation difference and the effect on the income statement from this account? Just from this account. There are no transactions whatsoever. We just keep that money in our bank account. So take a few minutes and think about that, and after that we will take a look at your solution.
Sir, I have one question. Do we take into account depreciation or not?
Well, do you take depreciation into account for cash?
No.
No. Cash doesn't lose value except for exchange rate differences. So the cash is current asset. Those are generally not depreciable. So no depreciation here, just value difference from the currency exchange rates. Okay, so does anyone want to do the first year, 2017, the book value in euro? We don't have any valuation differences there, obviously, as we don't have any baseline.
9,230,000 euros.
Yes. So we don't have any valuation difference here, but we value that at 9.23 million euros. Okay. So 2018?
8.48.
Yes. And what is our valuation difference there?
Let me difference. $1.07.
Again, please.
1.07.
No.
Do we take the difference always with 2017 in the upcoming years, or do we just take it to the previous year?
To the previous year, because we have to
750.
revaluate each year. So we have in this year 8.48 million. And then we have the valuation difference to the previous year, 750,000, which takes an effect on the income statement as it's lower of 0.75 million euros.
So now in 2019, it should be in compared to 2018.
Yes.
Okay.
Because we have an accounting entry, of course, here for 2018, as we have to adjust our book value of the bank account to 8.48 million. So we have something like revaluation loss, something like that, or so this would be our expense account for that, loss due to currency conversion. Let's call it in line with all the others, cash, but USD, our USD cash account.
So this is this loss that we just calculated, or that we just take out of this table. That is just on paper, right? Because we haven't actually yet converted the whole currency yet. Because otherwise there would be like conversion fees as well.
Yes.
If you're doing through like a particular service. So
yes, of course. But this is also in the case that we don't want to convert that money. Like we have no intention to convert those US dollars to euros, as we have a lot of transactions in the US, and with all our customers, it's just easier to have a Bank of America account in US dollars to receive money and to send out money for our US business.
So it's basically like stock markets. Like stock can go down like 20%, but it's not considered as a proper loss until you sell the stock.
Yes, that works a little differently in the accounting world, but from the logic, it's the same. Yeah. So it's just something. Well, it's assets, it's cash that we have in another. It's a special case because it's cash, as it's that liquid. And we just assume we don't do anything with our account. Like we have that account for preparation for US business of 10 million. We want to have that there. And but we have to include that in our financial statements, in our balance sheet. So we have 0.75 million euros that we have a loss then on the income statement.
So now in 2019, the book value is going to be 8.93 million.
Yes.
Euros, and the valuation difference should be 450,000, so 0.45 million.
Yes. And that is a plus now. So we
As
have
compared to the last year, yes.
So we have here then accounting entry cash USD. This would be our accounting entry for that. So we increase cash, and we have a gain on an income on the income statement due to these currency conversions. And the next years work the same way. So we have in 2020, then we have 160 million loss, 160,000 loss.
So we expect the 2020 will be the loss.
Sorry, again, please.
So we expect the 2020 will be the loss.
Yeah, there will be a loss in 2020, yeah.
And gain in the 2022.
And gain in 2022, yeah. So we have
1.05.
Yeah, we have then in 2022 a massive gain in that asset on our bank account, yeah. So as you can see, that has a huge impact on our income statement, right? I mean, we don't do anything. We don't have any kind of transactions here, but we have huge effects on our income statement. Is that practical? What would you say?
Well, it could be.
A little louder, please.
It could be practical if, for example, you know that the currency is actually going to be valued in the future. Could it be practical?
Yeah, but it means that we make a loss or profit just from having money, which could be an investment, right? But as we have that as kind of operating capital, that is kind of a huge effect on our business that does not necessarily reflect our operational business. And there we have our huge a huge impact on the balance sheet, on the income statement, from something that is not warranted from our operations. So just to show you that, I won't introduce that in this lecture, but this is from the annual report of Siemens. We have something called the consolidated statement of comprehensive income, and there we have currency translation differences. This is a separate part that is separate from the statement of income. So we have a net income here, shown here, and the currency translation differences are not part of that income, because it's not really warranted by our operational business, and we only want to show really the operations on here. So until we really transfer that money, as your colleague said, with same as stock investments, it's not really a loss or a gain unless we realize that. We don't really show that on the income statement, but we show that in a different category. But still, the valuation is the same, or as I showed you here, and it has a huge impact on our business potentially. Are there any questions to these currency translations here that we did? So take from this that there is a difference between the handling of monetary assets like cash and cash equivalents with foreign assets, and also with property, plant, and equipment, because property, plant, and equipment, we have one currency conversion at the point in time of the initial recognition into our functional currency. And for cash and cash equivalents, we do that at each reporting date, at each closing, for the closing rate. For currency monetary items. Foreign currency monetary items. Okay, so keep that in mind, that there's a difference here, a special case for real foreign currency. Then we take a look at payables and receivables. Payables and receivables are something that we took an extensive look at during recording of transactions, because they are highly relevant and they are, in the context of the IFRS, a type of financial instrument, but also a financial instrument that is very easy to account for because it's so common. So the definition for financial instruments is very broad. So it's any contract that gives rise to a financial asset of one entity and a financial liability of another entity. Yes, there's a question.
Sorry, Professor.
Yeah.
Why does return in doesn't show any losses occur on the company?
Sorry, again, please.
Why does return in statement does not show any losses occur on the company?
You mean the income statement is
Return in statement, the final year of the.
So why the currency translations are in a different category, not on the income statement?
Why the return in does not show any losses occur on the company? Like when we bought something at different currency, when you get some losses, yeah, but the return in does not show any losses.
The return in?
Yeah.
The return in what?
Statement, like statement of income.
So here in the income statement, why that doesn't show any kind of currency translations or?
No, losses, loss.
Loss,
when
yeah.
When the company get the loss.
Yeah, they show that whenever the loss is then realized, so to speak. So whenever we have, let's say, that would be in this category then, I think. Whenever we then, like so to speak, we have this case here with our financial asset. At the point in time at 2018, we move all our money. We remove all our money from the US and move that into back to Germany. And let's take out of the picture any kind of conversion fees. So we have all. We don't have to pay any extra fees for that. In this case, we have to show that, of course, on the income statement, because then we sell all our US dollars and get 8.48 million euros. And then that would be on the income statement. And we have those accounts down here. We have a loss due to currency conversion to cash. But in the specific case of the IFRS, for long-running accounts like this one, We have the difference that we don't show this effect directly each year on the income statement, but in a separate category of the income statement below not net income. So it's not part of net income. But that was just a side fact that I wanted to tell you from the real world. In our simplification, all of this is effect on the income statement. Does that answer your question?
Yes, you answer the question. Thank you.
Okay. So now let's go to payables and receivables. Oh, that's one too far. Yeah, another question.
Yeah, this is a little bit off topic, but I just wanted to ask, would we have a chance to have a mock exam from your side
Yes, we will have a mock exam in January.
in January?
Yeah.
Okay, and the table that we just did, is that one of the things we should actually consider and know thoroughly for the exam? This one.
It might be, but I can't say that not that anything won't be on the exam, but I will try to structure the exam according to approximately how much time we spent on each topic.
Okay.
So you can kind of derive from that how relevant some topics might be.
Understood. Thank you very much.
Yeah, you're welcome. So for payables and receivables, we dealt with payables and receivables a lot, as we always use accounts receivables and accounts payables, or trade payables and trade receivables, for whenever we have an invoice involved. So we send out an invoice, that would be trade receivables, and we get an invoice that we have to pay, that would be trade payables. So payables, something we have to pay, receivables, something we will receive. In the context of the IFRS, those two are financial instruments. But don't be afraid, we won't get into the financial instruments right now. We have trade payables are current financial liabilities. Oh, the mock exam, that will be something that I will upload to the iLearn course, and that you can do at home, and that we will discuss in the latest in the last session of the lecture. Then we will discuss the mock exam. Okay. So for the trade payables, we have current financial liabilities that are owed to suppliers for goods delivered or service consumed, and that all those that take place in the ordinary course of business. So those that are in the ordinary course of business, that would be trade payables. Anything else would be other liabilities. And also the other way around, trade receivables are current assets with the right to collect economic benefits in the form of money through the supply of goods or through services that we provided. And receivables and payables are, of course, symmetrical. So receivables for one entity are payables for another. So if we send an invoice to any kind of customer, we have a trade receivable on our end, and as soon as the customer gets the invoice, they will have to have a trade payable, so they have to pay that. So those are symmetrical over the world, over the whole business world, so to speak. Something we have to remember here is that payables are not in the power of the entity. We can't control anything of the payables. Those are just liabilities for us. So, but on the other hand, receivables are assets that can be bought and sold by the company. So that is something that is specific mostly to the financial sector. But let's take a look for example, what happens if a customer does not pay a receivable. We have several options for that. We have, on the one hand, collection efforts. we can send an employee to the home or the business of our customer, and then have them ring at the door and ask for a collection. Or we can sell receivables to others, so others can have that kind of effort and collect, but we
And
get...
we sell it to the mafia.
Sorry, again? Okay. Or we can write them off. And I think all of you have been a case of factoring of receivables, whether you did that willingly or not. Whenever you do online shopping, you have at most shops you have the option to pay, at least in Germany, with the company of Klarna. I don't know if that is if that company is known to anyone, but what happens here is factoring of receivables. Let's say you owe an online shop. For example, it's a bad example, but for example, Amazon, you buy something for 100 euros from them, and they you select Klarna as a payment option. Then you don't owe Amazon 100 euros anymore, but Klarna, because Amazon sold that receivable to Klarna for maybe 99 euros. So now Klarna bought something for 99 and will receive 100 from you, and that's how they make their money. And they do that extensively. I can show you the annual report on page 73. You can see here loans to the public. That should be in millions, I think. They don't specify that. That should be in millions. So I think that will be 80 billion euros here, loans to the public, which are newly originated. So those are all those receivables that Klarna bought from all those online shops to collect on it. And that's how they conduct their business, actually. A very interesting form of business, I think. But we have also the overlying goal of informing our investors on everything that goes on in our company. And we have to inform them on repayment risks. So there are risks that our customers don't pay. How do we out of those, I think I have about, yeah, that might be the case. If you have 50 billion euros in Klarna, then congratulations. Then I hope you are somewhere where they won't find you.
Oh, trust me, they try to find me and they call me almost every day.
I can only imagine. But we have to inform our investors. If we don't sell that to Klarna, we have to kind of inform our investors on the repayment risks that our customers won't pay us. So how do we do that? Any ideas? How can we inform our investors about that?
Can't we just message them, or what exactly?
No, we just, yeah, well, we message them, or we just clarify that in our financial statements. We mostly in the notes, we will say, like the table you just saw for Klarna, we have that amount of receivables, and typically our customers pay 99.5% of those receivables, and those 0.5% may never pay our receivables. So that would be informing them, and that would be in most cases sufficient.
Yeah, but not all companies notify the customers, but it record as the loss from the statement. When it come, you back again to the business, you back the money in advance. After that, we can't give you any service until the lifetime. So that is it. And yeah.
Yes, that is the more complicated way of looking at it. We also kind of do that. Is, I think what you meant is something on here, which would be the allowance for credit losses. Is that it? What you meant?
Yeah, it's really it. And I've done this one from one company. I've taken the loan. Yeah. After that, I didn't pay for 10 months. After 11 months, I paid, and they blocked me. There's no any service done for customers who never make the payment at the deadline. Yeah.
They also charge like heavy interest on people, the due or outstanding amount. So I think for investor, that shouldn't be that big of a problem. When a credit company or the transaction company like Klarna owes a lot of money to other people, because at the end of the day, they get their money either from the people or the debt collection agencies.
Yes, typically the only part where they typically won't get any money anymore is when the customer is insolvent. So if there's an insolvency case opened. But what your colleague said here about the allowance for credit losses, that would be the percentage that I just spoke about. So we have a higher percentage here than 1%. So that is something we reduce our receivables directly to account for the risk that the customer won't repay that. But I didn't mention that explicitly because I didn't want to torture you with the allowance for credit losses, because that calculation can be quite extensive and a huge risk model behind that and all that. Okay. So for the last topic today, we will take a quick look on provisions, which are central. Well, no, actually, I think the provisions will be something for next time, because they are a little more important, and I can only imagine how stressful this session online session was. There's a question in the chat: how do they balance with credit loss? That is also something that is then, so we have the allowance for credit losses, and that is also takes effect on the income statement. So that is something that has an effect on the income statement and then on the balance sheet. So we reduce our asset, and that is also an expense when we account for the credit losses. Is that what you meant? Or is that what the question was about? Yeah. Okay. So the provisions we will take a look at next week, and next week we will be back at the campus in a normal fashion. Thank you for attending online with this short notice, and see you next week. Thank you very much.
Goodbye.
Okay, goodbye.
Yep. Thank you, Professor, and gute Besserung.
Thank you.
Thank you, sir.